This is TreppWire Week in Review for week ending May 8th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with our own Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. As always, this week, more than half the states are now moving toward a reopening, but we're still dealing with news of increased infections and economic data that tells us we've got some ways to go toward a recovery. Jobless claims fell slightly to 3.2 million last week, and the markets reacted positively to that slight decline. In all, more than 33 million are out of work. And with the lockdowns lifted, all eyes are on some key sectors as they prepare to be open for business. It seems people are looking for upside in the news, Manus. Help us sift through some of this to get some real takeaways.
Well, I think they've seen some upside. I think they've seen a rebound in oil prices. I think they've seen a rebound in some oil stocks, which has been a positive. And the NASDAQ today flipped from red to green, meaning it's made back all of its losses from the beginning of the bear market a few weeks ago. But it feels like a very bifurcated market, a tale of two types of markets and two types of people, right? On the market side, you have the tech companies that are really leading the way, powering higher, somewhat immune to the coronavirus headlines and the true effects, right? We saw Microsoft really shrug off any impact at all. Facebook came in better than expected. You know, the FANG stocks have done extremely well, and everybody else is kind of bringing up the rear. And that could be retailers, hotel companies, REITs, restaurant companies, gyms, it's everybody else. And if you extend that to the broader US economy, I think it's the same person by person. If you have a job right now and you're receiving a paycheck every week, you're probably feeling okay, we'll muddle through. And if you don't, I think you're wondering when and if this will get back to normal and what's it going to look like on the other side.
Well, there's also the dichotomy of what the stock market is doing versus what the macro fundamental economy is doing. Right. The stock market has gained back a lot of what it had lost. I think it's pricing in an idea that things will recover very quickly. I don't think that it's, and maybe I'll take a negative view here. I don't think it's properly pricing in the idea that it's going to take a lot longer to recover. But then again, where else can people put their money right now? I mean, they can put them in 0% savings accounts and things like that. So there's always the concept of there are still trillions of dollars flowing into 401k accounts and pension fund accounts and things like that that have to be put to work somewhere. So that does, put some sort of floor under equity prices and even bond prices. But, that tale of two cities almost can be extrapolated into the market.
I'm not a believer of the FANG stocks being immune to any problems, honestly. I think at the end of the day, if you're seeing 15 or 20% unemployment, which some have talked about, or a negative 20% GDP, at some point your customers start to erode. You start to lose advertisers, you start to lose buyers, and you start to lose companies that are doing business with you if you're Amazon Web Services. And that at some point has to hit your bottom line. They do seem to be priced for perfection. And I don't think we're going to see a perfect rebound. And I look at the two sages of 6 or 7 decades of investing, Warren Buffett and Sam Zell. We talked about Sam Zell last week, and we were hoping to get him on the show. It turns out he did an interview this week, and in his case, he sees nothing but downside right now to equities, to properties, to hotels in particular. He thinks that we are priced so far above perfection that he can't believe it. So we talked last week about whether he was getting out his dancing shoes, the fabled grave dancer Sam Zell, and clearly he is not. He's got his high top still tied tight right now. He's not putting on the dancing shoes yet.
He's got his Chuck Taylors on.
He's got his Chuck Taylors on. And in Warren Buffett's case, even though he talked a lot about American ingenuity and America being the place to invest, he also admitted he didn't see any place to put money right now. And I think, if I'm looking at this market in broad terms, I'm looking for the guys that have been through several wars, right? Through the economic downturn of the 70s, late 80s, early 90s, post 9/11, the great financial crisis. If they don't see things to tap right now, I don't either.
Yeah, well, I think Sam Zell's ducking us, by the way. He doesn't want to come on the podcast. We'll see if he comes on next time. I may have something un-PC to say here, which is, first of all, let me preface it by saying that these two men are infinitely smarter than I am. But there has to be some layer in their subconscious that sees the risk, a health risk, like the coronavirus, as something more negative than somebody like me, right? Like the millennials of the world are looking at this and thinking, okay, I don't want to go see my grandparents, or, I want to make sure my parents are safe, but I'm like, I'll get back on a plane in 3 months, right? Like, so I think that their idea could potentially be skewed just slightly by that fact.
It's interesting for you to say that. I'm glad you took it in the way that you did, because when you started, I thought we were going to hear a rant about ageism, that maybe Warren Buffett with his $150 billion in cash on the sideline was kneeling on the football or playing prevent defense, thinking he's gotten 5.5 decades of great returns. And, he doesn't want to put those at risk. Neither he or Sam Zell are buying green bananas anymore. So, but I think that both of them, if they saw the right opportunity, would jump back in.
So what do we take away from what they said or didn't say? Investors that would listen and hang on every word were probably thinking they came away empty-handed. What do you take away from that?
Well, I think, Manus brings up a quick point there that I'll just say really quickly, is like, for somebody like me who has a long time horizon, this type of market is potentially very good, right? For people who are, closer to retirement or in retirement, it's not good, right? But hopefully they were positioned correctly, more in low risk assets. So, the way I see it is that we will recover, the economy will recover. So, and I have the time to wait for it to recover. But, that's just my opinion. That's just my kind of viewpoint. So everybody's viewpoint is going to be a little bit different. And I do think that it's going to take way longer to recover than many are kind of pricing in right now.
I think the takeaway for most people was caution, right, from both of them. Don't be chasing returns at this point, and probably more explicitly, if they chose to be, it would be keep your powder dry, right? There'll be a better entry point at some point in the future than there is now. And I happen to agree with that.
Looking at reopening, retailers and hotels are giving us a preview of some of the challenges that we could be looking at overall. Let's first take retail, and then we'll move on to hotels. What are we seeing in retail?
Well, I think that you saw a lot more negative headlines this week. And, I'll rattle some of them off. We saw Neiman Marcus file for bankruptcy that was long rumored. It finally came to pass this week. Lord & Taylor, sadly, will be liquidating. I always liked Lord & Taylor. I thought they had a great product mix. They made me look good many times, better than I probably deserved.
A lot of, semi-formals and prom shopping happened there.
I do recall when I was young and I didn't have a lot of coin in my pocket that I would take my kids to Sears, which was always like a little messy. Things weren't put away very nicely. And there was like, piles of stuff. It was just kind of chaos. And I took one of my kids to Lord & Taylor one day, and they turned to me and said, I am never going back to Sears again. So that's my recollection of Lord & Taylor. I do love the store. I think it was great. But they're going Chapter 7, it would appear. And Nordstrom yesterday said that they're going to close 16 of their department stores, which represents, I think, 10 or 15% of their base, which, if you're thinking that this is a V-shaped recovery, you're not doing that, right? If you're closing stores, right, you're thinking that this is a long, slow slog, and you're looking to cut costs and raise cash wherever you can.
Well, open retailers are creating safety guidelines and are including reduced density. They're providing masks and PPE and adding sanitizing procedures. Is that enough to get people back into the store or the mall?
Well, let's talk about two things first. I'll throw in one more point about this week's headlines, and then I'll cut to your question. We did start seeing some remittance data come in for May. What we did see was a couple of single asset retail deals remit this week. It's a big week for single asset deals. Several of them, several $100 million plus loans posted to be on watch list for the first time, with the comment being that the borrower had kicked off the process of requesting a forbearance. I won't name the borrower because I don't think anybody should be shamed in this market. I think that we're all in this together. However, it is a deep-pocketed major retail property owner, and if they're being impacted by this, everybody will be. On the opening up of things, I'll take us on a little bit of a meandering path here and go back to Amazon's earnings for last week. We talked about this briefly, that they were going to spend the entirety of their profit, $4 billion this quarter, on COVID-related items. And I will take a little bit of a conspiracy angle on this. I'm not a conspiracy guy. I don't really believe in those. I'm not Area 51 or, UFO thing. It's not my gig. But I do think that in last week's announcement, there was two parts to this from a corporate level. Part one was protecting the franchise. They had gotten some heat for not protecting their workers, for not putting enough money into cleaning their warehouses. I think part of it was to show the public that they were committed to this. But I do think the other half of this was throwing down the gauntlet to the Brookfields, the Simons, the Washington Primes, the Meseriches of the world to say, we are going to clean and clean and clean. And unless you do the same and spend a lot of your dollars on cleaning your stores, we are going to lap you. And it was a way of them making it even harder for the retailers, the brick and mortar guys, to compete. This was the retail equivalent of the Saudis dropping $20 oil on the market in droves.
So let me take kind of two. I agree with you in some ways and disagree in others. So it's clearly to me, it's a PR move for Amazon, right? To say that they're doing this. And who knows, when they say $4 billion in COVID, quote unquote, COVID related expenses, who knows what that really means, right? But everyone who didn't shop online before this has now figured out how to shop online, right? So I don't know what the number is, like something like 10 or 15% of all consumer spending was online before
their
this.
Earnings are 26% higher than last year, same period. So they're making money.
Right. So, but what I'm saying is that coming out of this, whether you clean your store or not, it doesn't matter because, grandma figured out how to shop on Amazon, right? And the people who have continued to go to the malls and continued to go to these stores in person have figured out that they can shop online. Now, it doesn't mean they're never going back, right? But I'm just saying that this was the push or the accelerator of online shopping in general. So no matter what you do to clean your stores, it's, you're not getting the same number of people coming back, whether it's COVID related or not.
Well, here's my pivot to that. And Amazon has never avoided throwing high and tight, right? They are, happy to throw chin music whenever they can. They compete very hard. And nothing would make them happier than to see the entire demise of the shopping mall, right? That is their goal. And if they could force Simon and Brookfield and Washington Prime and Macerich and others to double or triple their janitorial costs and other things, they'll do it because they want to see all these guys go the way of Toys R Us and Babies R Us and the Sports Authority and everything else.
Right. If I'm a retail investor at this point, I hope I'm just a triple net guy to Target and Walmart, right? Because Target, those guys have done very well in this. Right. I think that Target had like a 250% increase in online sales in their quarterly numbers that came out a week or two ago. And, you know, you could see, I mean, barring, you know, some sort of monopoly rules or antitrust rules, Bezos could end up saying, I want to buy Target, and they become my distribution network, you know? So you could see something like that, but I doubt that the federal government would allow it. But yeah, I don't see Simon or any of these other guys coming out of this better or even close to where they were before. Although, let me contradict myself. This winter, I went to the Westchester Mall, which is a Simon property, probably like 7 or 8 times. I haven't been to that mall more than 7 or 8 times in my whole life, but they have built it out into a pretty nice food court. They have like a little indoor playground. They have like all these types of activities. I got my picture with Santa. I mean, my picture with Santa, my son's picture with Santa. But I do still see that, you know, you need somewhere to go that's other than your house. And, you know, maybe there's a reverse effect coming out of this. Maybe if we get a vaccine where people are like, I can't spend another Saturday in my house after I've been in my house for 3 months. So I'm going to the mall, even if I don't need any, you know, Jimmy Choo's or anything. I still want to go get a slice of pizza and walk around and see human beings.
Did you do the family picture, the portrait, you know, with your
for like $99? Yeah,
you know, with your son in the bow tie and your wife licking her palm to like mat down his cowlick?
I will say that my son was epically well behaved with Santa. It was more just amazement about what's this guy up to. But then they get you in this line, and then when you get out of the line, they say, oh, we took your pictures. Would you like the pictures? And you're like, well, yeah, of course I want the pictures. Okay, sign up here. And it's like $47.99 or something. I'm like, holy moly, Santa's got a racket going on there.
Take out your camera phone. Well, let's turn to hotels. What kind of exposure are we seeing in that sector, Manus?
Well, you know, nothing real great. You know, I think if you want to see the greenest of green shoots, we saw some data which showed that, you know, occupancy had bottomed out. You know, we were talking about last week, hotels, you know, running at 20% of capacity, maybe less, 15%, 10%. We did see a small uptick. Hopefully May brings, you know, more of that as certain cities and states start to open. But I think it's an awfully long slog, right? I don't see business travel coming back anytime before the fall. And even then it could be a fraction of what it was. I don't think that conference travel, you'll see any of that this year for the remainder of this year. You could see some vacation travel, but even if that comes back to 40 or 50% in the second half of the year of what it was, but you've wiped out business and you've wiped out conference travel and things like that, then what are you left with? So I think that's that will be the hardest hit. We should see a lot of data coming in over the next 4 or 5 days. We'll publish a lot of that on Monday, Tuesday, Wednesday morning next week. So if you are a TreppWire recipient of our daily commentary, you will see what that looks like. Last month, we were north of 20% of borrowers who did not make their April payment. It wouldn't shock me to see that go to 25, north of 25% this month. You know, one thing that borrowers are grappling with right now, and I'll throw it back to Joe and Martha in a minute with their thoughts, is do you open up your hotels to the government now to house either, you know, first responders so they can be more on the spot, or sick people or homeless? And we will be writing about this on Friday morning about a hotel in Queens that has been contracted with by the city of New York to take over the entire hotel for 60 days, which could provide an immediate boost for some of these borrowers. But it also, there's only so many hotels willing to do that. So we'll have to see how that plays out.
Yeah. I mean, the type of hotel that would probably say yes to that is also the type of hotel that the people who are going to it probably aren't thinking too hard about, you know, the quality. right? I mean, I'm not even trying to make a joke either. Like, think about like a Holiday Inn Express or something. Like, I know that's going to be a decent quality, but I'm not thinking it's the Waldorf or, some very high level thing. So as long as when I walk in, the room smells okay, I'm pretty good. But if I was one of these owners opting for this, I would be hoping not to have anybody write any news stories about it, if you know what I mean.
Well, I think that you have a couple of thoughts about this. Number one is I think it may actually be an opportunity for some of these guys that were struggling and maybe had Class C hotels in major cities to see their hotels taken off their hands at a fair price and repurposed for either housing for the homeless, or maybe even some kind of repurposing of multifamily somehow. Maybe that is an impetus for that. But what I would say is that I do hope that it becomes an arm's length transaction, a fair market value pricing between property owners and the government. I mean, there's talk, I believe it was Commercial Observer this week that said in California, people are urging the government to seize properties. And to the extent that borrowers are getting hammered with eminent domain at unfair prices, I wouldn't be an advocate. But there could be some upside here societally and for struggling borrowers if it's done the right way.
Yeah, well, I don't think if it's eminent domain, I don't think it'll be done the right way. And also, the government could be taking advantage here by saying, what's the market price right now for an empty hotel? It's probably 30 or 40 or 50% less than what the market price was 3 months ago.
Yeah, I mean, we want to see our leaders do the right thing, and doing the right thing would be paying, what a market rent would have been in January, or 80% of that at least. But, as I said, perhaps this is a vehicle to improve the stock of housing, right, for the indigent. Let's hope so.
Well, yeah, well, there's some, 100,000 empty hotel rooms right now. And about 30,000 in New York City will probably be used for this endeavor.
New York was facing a glut to begin with,
yeah.
Right? And I'm sure that people who put up hotels or had boutique hotels are not going to be on that list of owners that want to put this out there for COVID patients or for the homeless. But there's plenty of B and C stuff that is dated, and these are refreshing, that it might be repurposed.
Well, if I was an enterprising homeless person, I might take advantage of one of these programs and then read up on squatters' laws. Because if you just stay there long enough, they can't kick you out. You could turn it into your own apartment eventually.
Your legal advice is probably...
I am not a lawyer, nor am I an
accountant
or a tax expert.
You need a big disclaimer here, Joe.
You've taken on...
I've taken on ageism. I've taken on homelessness. What's next?
That's right. You've offended about 65% of our audience so far. Let's see if we can finish the job.
65% or 65 and over.
Yeah,
right.
Exactly. Well, one of the things we've talked about is a need to rethink how we assess risk going forward after this is all over. How do we do that?
Well, I think the first thing you need to do is, as an individual investor, or a property owner, potential property buyer, you have to basically price to worst. And pricing to worst means, what is the worst possible outcome that you can see, right? Is it a 40% recovery of airline travel and business travel? Is it 60, 80, 90, whatever? The first thing you need to do is kind of figure that out. And then, if you're in the office space, I think a lot of it is credit, right? What are we looking at for credit here? What do we have? If you look at something like Chicago, right? Just this week alone, we saw Groupon and Career Builder put 250,000 square feet of space on the sublet market, right? All of that shadow inventory is going to grow in every major city and probably every mid-sized city, right? That has to be part of the calculus, right? That not only are you seeing demand dribble away, but you're going to see supply really explode in some cases. So I think it really means changing your baseline for the macroeconomic view, for the length of time that this downturn continues, and then what we look like coming back. And I do think that when you add that up together, I think that a lot of these hotel and retail properties are probably 30 or 40% lower in value today than they were at the end of last year.
Yeah, thinking about from my very in the weeds, granular, boring perspective of data monkey and modeler, a year or two from now, where it's going to be very important to be able to look back on the data and the information and understand it, and also to have been all along capturing maybe potentially new or different data points that we never thought of before, like what loans are in forbearance, how much forgiveness there was, what were true modifications, what were the forbearance requests that shouldn't have been requested because the property was still doing okay versus the forbearance requests where they were really in trouble. Do you consider that a delinquency or a default? How do you take into account the epic levels of stimulus in the market and factor that into your kind of macro equations? So we will surely be spending the next several years dissecting everything that happened here and digging through the rubble and trying to figure out how to, incorporate it into credit models, pricing models, all that type of stuff. However, we already did that with the last Great Recession, right? And then this thing happened. Nobody expected this to happen. So, from the cynic point of view, we're going to spend all that time and we're going to do everything we can. And then something out of left field that none of us expected is probably going to happen about 10 years from now.
Well, we kind of fought the war together, Joe, you and I, from 2010 to 2015, working with the top 50 US banks to help them hone their models to meet their mandates from Dodd-Frank to allow them to do stress testing. And, as people who've done this before, there were three scenarios that the Fed made banks perform, right? A baseline, which was modest economic growth, an adverse, and a severely adverse. And the severely adverse, when we were building it with the banks, was calling for things like 13% unemployment and -6 GDP. All of a sudden, that does not look like severely adverse, right? Now that people like Goldman Sachs are talking about 20 or 24% negative GDP, and others are talking about 20% unemployment. All of a sudden, that seems like the moderate scenario. So I think, you're going to have people go back and rebuild all these models for that stress. And your most severe scenario is going to be a black swan for which people will look at all this data 2 and 3 years from now and say, all right, this was a black swan. How did borrowers behave in a black swan? And the models that get built will look nothing like the models that got built from 2010 to 2015.
Right. We've run several clients, entire bank balance sheet, income statement, capital ratios, everything through our bank stress testing models with coronavirus scenarios. And I will say, just from the couple of results sets I've seen off the top of my head, that they still look better than the severely adverse, but that's because the COVID scenarios that we're seeing are up to 12 or 13% unemployment and then a quick recovery, right? -7, 8, 9, 10% GDP growth, and then 11, 12% GDP growth a year later, as opposed to the severely adverse, which is a quick downturn and a very slow recovery. So, again, that might not be the right scenario to be using at the time, but it is something that a lot of banks regulators are asking them to do right now, is to, rerun all of their stress testing, rerun all their risk management protocols with this whole, COVID macro economy taken into account.
I do think that one of the new paradigm shifts that nobody really has talked about, as far as I can tell, is that I could see large employers pivoting away from salaried employees with, kind of permanent employment to something which is more contract in nature, more consultants, the kind of thing where instead of, going from let's say 50,000 employees down to 20,000 after a furlough. As you kind of ramp back up, you're not ramping up to the guy that you're expecting to be there for 15 or 20 years. It's more of a, let's dip our toe. Let's find consultants to do these jobs for 6 months. Let's see how it comes back. Let's see if our clients revisit. I don't think you're jumping in whole hog trying to go back to 100% capacity with the number of employees that you had in the past. And that's kind of worrisome, for the broader economy. The human face of that is not pretty. There's a lot of uncertainty.
Yeah.
Looking at corporate loans, we're going to be publishing a report on downgrades in the coming week or so, but the stream of negative news coming daily is pretty tough. So how should investors assess the impact in this market?
Well, I think that the time to get out was probably March 7th, and we did see that in our own data, in our CLO data, kind of in spades. Tons of selling of airline credits, oil and gas credits, hotel credits, restaurant credits, anything like that. At some point, we will look at this data holistically and look back, and there will definitely be winners and losers out of the managers out there. There'll be the savvy guys who really saw this very quickly. Maybe it's savvy, maybe it's lucky, who said, sell, raise cash, let's keep our powder dry. And there will be, some that were very slow on the uptick. But we see it all the time when we look at a particular loan in a certain industry, whether it's a gym or a restaurant operator or something like that, that there were guys out there selling the credit at 80 in late February as quickly as they could. And there were guys that held on to it and were selling it at 50. And it hasn't been a great market for differentiation, right? A lot of managers looked very similar over the last couple of years. It wasn't easy to make a name for yourself as standing out, but I think that there will be guys in this market that look like the Steve Carell's and Brad Pitts of The Big Short. And there'll be other guys that look like they were the AIGs and others.
Look like the Michael Scotts.
Right. That's right. Right. That wish that they were a little bit quicker to move.
Well, there's certainly, if you believe in the resiliency of, America in general, there are certainly opportunities out there. I mean, there are SASB bonds that have, 20 or 30% credit enhancement that are priced at 50 cents on the dollar, right? So we definitely have a lot of inbound clients and, past clients who maybe had left the market, who are coming back in droves right now looking for this stuff. Now, obviously, I'm sure most of the big, giant, chunky returns have already happened over the last couple of weeks, but there's still a lot of opportunity out there, especially we're seeing more real estate specific players who generally invest in properties are looking at this market and saying, I can't make a big, giant, distressed play in the property market because nobody's selling. There's no active market to buy or sell a property right now. But I can go in and invest in a bond that is backed by, a property or a pool of properties that I understand because I live in that market, whether it's a hotel or retail or whatever it is. So, I know we've looked at it, and we've done some very simple math on some of these deals to say, even at significant CDRs or default rates and loss rates, the bonds that are priced decently below par are money good. So that's kind of the analysis that's going on all the time right now.
Yeah. I would say that the recovery has been largely the AAA recovery. That's retraced a lot of its ground, but I do think that there's a lot of opportunity down the stack to get stuff, like you said, at dollar prices of 40 or 50. Everybody wants to recreate the Appaloosa magic of 2009, right? Mm-hmm. When they piled into AJs and AMs at 20 and 30 cents on the dollar, and 2 years later, those things were back at par, right? And are we there yet, right? Are we going to see these hotels go back from 40 cents on the dollar, the triple B minus, back to, 95? I don't know. Or is it going to 35 first? It's really hard to say.
Yeah. Yeah. And a lot of these guys, that we're talking to are, they're not, they're taking the long view. You know, they're not, there are traders out there obviously trying to jump in and jump out, but the more real estate, specific guys are thinking, hey, I could buy this and hold it for 3 years until maturity, and it's going to be money good, and hopefully I could sell sooner if it recovers really quickly, but I'm good to hold it.
Well, we spent a lot of our time talking about the economic impact of the pandemic, but there's a very real human toll, and I know each of us has had some experience with that. And there's a lot of people that are doing heroic work to support the people who need it most, and it seems people are stepping up, at least from what I'm seeing. What are you guys seeing?
I would like to reiterate what we've reiterated periodically through the other podcasts, that, one is thanks to those people that are on the front lines, right? Police, fire, medical, so forth, to those that continue to work in places that Americans need to be open, right? Shopping, not shopping malls as much as grocery stores, right? Targets, Walmart, stuff like that. We can't show our gratitude enough for keeping the economy lubricated as we need it. And, I think each of us has known somebody in our lives that has been taken down by COVID, perished from it. And, in the past we've said, for those of you that can spend, keep spending. And this week, what I'd like to say is, for those of you that have the means, that can support somebody in your community that has a GoFundMe page, who may have been a mother, a father, right? Somebody who is an income provider for a household, be as generous as you can in these times, because I think we all have to work together as best we can.
So I agree with all of that. And, we have fun on the podcast, but of course we understand the gravity of what's going on. But to tell a little story, the beginning of this year, I was on a plane, I think 7 or 8 times, or I was on plane like round trips 7 or 8 times in the first 5 weeks of the year. And I had booked a flight to Milan for a client conference to go, do some stuff at a client conference that you do, right? Talk and meet people and everything else. And
is it a boondoggle? Or
no.
It
was, well, it might've been a boondoggle, but it wasn't our boondoggle. And
boondoggle.
So it was literally the Friday on the way home from work. I booked the flight to and from, right? Emirates Airlines out there, Finland Air on the way back, whatever it was. And over the weekend, I turn on the TV and it says new epicenter of coronavirus, Milan, Italy, right? So the next week we come in and we say, okay, this thing's going to be canceled. So I, went through the whole refund process and whatever. That was about 2.5 months ago. I just got the credit in my credit card from Finland Air 2.5 months later. You know what I did? I direct messaged them on Twitter every single day until they gave my money back. So how do I bring this all together? I'm going to use that credit because I already paid the credit card bill months ago. So it's almost like found money, So I think maybe I'll take a poll of our listeners what I should buy, but I'm thinking washer, dryer, refrigerator, some sort of capital expenditure to really do my part to support the economy here.
Donate it.
I think you should buy a new car for a first responder.
It wasn't that expensive of a flight, Manus.
I thought you were a first class guy. I thought you could at least pony up for a Ford Fusion for somebody,
Maybe a Pinto.
Pinto.
That's good. Well, we've all gone a little stir crazy in our home environments, working round the clock. But it does seem that people are coping pretty well. Is that surprising?
I'm shocked, to be honest. I don't get it, right? We were talking earlier in the week, at Michigan, people are protesting and they want things open again, but that's anger, right? People are angry. They want things open. I'm surprised we haven't seen more madness, right? People going out of their minds, cooped up with their kids, trying to explain, why S is sometimes sounds like S and sometimes it's shh, right? And or explaining the times table and why there's not people running down the street like Will Ferrell in Old School out of their minds at this point. I really can't explain it. If you told me I was going to be cooped up for 60 days with, my teenage plus kids, eating up bandwidth, eating us out of house and home, and watching terrible television. I thought I would be Will Ferrell running down the street by now.
We're going up through the quad into the gymnasium. Snoop.
That's right.
Snoop-a-loop.
You can be, was it Big Blue or what his name is? Blue?
You're my boy, Blue.
You're my boy, Blue.
I will say that I was out walking around the other day, and I saw one woman come out of her house, and she saw another woman that's in the neighborhood, and they started talking. And the woman who was in the house said, "This is not sustainable. This is not going to work." And the key here is that the weather has been bad for most of this. It's been rainy and cold. Another week or two of 75 degrees and sunny, and you might start to see madness, or at least full-blown revolt of the stay-at-home order.
Well, that remains to be seen. So with that, we'll wrap. A nod to our producer, Keegan St. Ange. Join us next week as we look at what's happened during the week and how it may be impacting you. If you'd like to have us answer a question, drop us an email at podcast@trepp.com. Until then, visit trepp.com for more info and subscribe to the TreppWire podcast with your favorite provider. Thank you and stay well.
All right.